There's a hidden crack forming in the foundation of global markets. Right now, in real time, and most investors have no idea it's happening. For decades, one of the world's quietest financial engines has been pumping cheap liquidity into American stocks, bonds, and risk assets. Financial analysts estimate hundreds of billions of dollars, possibly exceeding $1 trillion when including derivative positions, have flowed through this single mechanism. It's called the Japanese yen carry trade. And according to many economists and institutional strategists, it's beginning to break down. This isn't just another market correction. History shows us that when massive leveraged positions unwind, the effects ripple through every corner of the financial system. If current trends continue, what's happening in Tokyo could trigger a chain reaction that hammers U.S. markets harder than most retail investors are prepared for. Let me explain exactly what's at stake. The yen carry trade has been one of the most profitable strategies in modern finance. The concept is simple, elegant even. Japan has maintained near zero or negative interest rates for more than 2 decades. Traders and hedge funds borrow yen at virtually no cost, convert that currency into dollars, and invest in higher-yielding American assets. Stocks, corporate bonds, real estate, tech equities, anything that pays more than the cost of borrowing. The profit comes from the spread. You're borrowing at 0.1% and earning 5, 6, maybe 10% on U.S. investments. Multiply that across billions in leveraged capital, and you're printing money, quarter after quarter, year after year. This trade worked because of one critical assumption. The yen would stay weak, Japanese interest rates would stay low, and the dollar would remain strong. For nearly 30 years, that assumption held. The Bank of Japan kept rates pinned near zero. The yen depreciated steadily, and global investors piled in, building larger and larger positions. But something fundamental is changing. In March 2024, the Bank of Japan raised interest rates for the first time in 17 years. They moved from negative 0.1% to a range of 0 to 0.1%. Not dramatically, not aggressively, but enough to signal a shift. Then in July 2024, they raised rates again to around 0.25%. Many macro analysts argue this is the beginning of a long-term tightening cycle. Japan's inflation is rising, wage growth is accelerating. The structural deflationary forces that defined the Japanese economy for decades are reversing. And when interest rates rise in Japan, the entire logic of the carry trade collapses. Suddenly, borrowing yen isn't free anymore. The cost of maintaining those positions goes up. At the same time, the yen starts to strengthen. That's the killer. Because if you borrowed yen and invested in dollars, and now the yen is rising, you're losing money on both ends. Your borrowing costs are higher, and the currency is moving against you. History shows us what happens next. Traders don't wait for losses to compound. They unwind fast. To close a carry trade position, you have to reverse the original transaction. Sell your dollar-denominated assets, convert those dollars back into yen, repay your debt. When one fund does this, it's manageable. When hundreds of funds, banks, and institutional investors do it at the same time, it creates a feedback loop. Selling pressure in U.S. markets, rising demand for yen. More currency appreciation, more losses, more forced liquidations. The cycle accelerates. Many economists suggest we saw a preview of this in August 2024. The yen surged nearly 12% in just 3 weeks. U.S. equity markets dropped sharply. The Nikkei Japan Stock Index suffered its worst 2-day decline since 1987, plunging over 12% on August 5th. The S&P 500 fell 3% that same day. Volatility spiked across global markets. Credit spreads widened. Analysts pointed to carry trade unwinding as a major driver of the turbulence. Markets stabilized. Central banks intervened verbally. Traders calmed down, but the underlying structure didn't change. The positions are still there, the leverage is still there, and the pressure is building. If current trends continue, many strategists warn the real unwind hasn't even started yet. Consider the scale. Estimates vary significantly, but financial analysts suggest the total size of yen-funded carry trades could be anywhere from $250 billion to over $4 trillion, depending on how you measure it. The Bank for International Settlements estimated around $250 billion in direct yen-denominated loans to non-banks outside Japan as of March 2020. But When you include foreign exchange derivatives, cross-border bank lending, and synthetic positions through swaps and forwards, some estimates suggest the figure could reach into the trillions. This isn't just hedge funds, it's pension funds, multinational corporations, sovereign wealth funds, banks using yen funding to finance dollar investments. The complexity and interconnectedness make precise measurement nearly impossible. But one thing is clear, according to market observers, the positions are massive. When positions of this size move, liquidity dries up. Bid-ask spreads widen, markets gap. The assets most vulnerable are the ones that benefited most from the carry trade: inflows U.S. tech stocks, high-yield credit, emerging market equities, anything that offered higher returns and attracted leveraged capital. History shows us this pattern repeats. The Asian financial crisis in 1990, then the Russian debt default in 1998, the global financial crisis in 2008, in each case, according to economic historians, a sudden reversal of capital flows triggered cascading liquidations. What seemed like isolated problems in one region spread globally within weeks. Many strategists argue the yen carry trade is one of the most systemically important trades in global finance. It's been a hidden source of dollar strength, a quiet driver of U.S. asset prices, and a stabilizing force in currency markets. When it unwinds, all of those dynamics reverse. The dollar weakens. U.S. assets face sustained selling pressure, currency volatility spikes, and global risk appetite collapses. There's another layer to this that most people miss. Japan is the world's largest net creditor nation. Japanese investors hold trillions in foreign assets. Much of that is in U.S. treasuries. If Japanese institutions need to repatriate capital to cover losses, manage currency risk, or meet domestic obligations, analysts suggest they could sell treasuries. That pushes U.S. yields higher. Borrowing costs rise. Mortgage rates spike. Corporate refinancing gets more expensive. The feedback loops multiply. Some economists suggest we're entering a regime change in global capital flows. For decades, money flowed out of Japan into the rest of the world. That created stability. It kept global interest rates low. It funded deficits. Now, if that flow reverses, the system has to adjust. And adjustments in trillion-dollar markets are rarely smooth. In January 2025, the Bank of Japan raised rates again, bringing the policy rate to 0.5%. Market analysts noted this was another step in the normalization process. The central bank signaled more hikes could be coming if inflation remains above target. Each rate increase makes the carry trade less attractive. Each increase strengthens the yen. Each increase forces more unwinding. The momentum is building, the direction is clear. And the question isn't whether the carry trade will continue to unwind. Many analysts argue that process has already begun and will accelerate. The question is, how fast, how disorderly, and how deep the contagion spreads. Retail investors don't see this coming. They're focused on earnings reports, Fed policy, inflation prints. They're not watching the yen. They're not tracking cross-currency basis swaps. They're not monitoring repo rates in Tokyo. But institutional investors are, and many of them are quietly reducing risk, hedging exposure, and preparing for volatility. History shows us that by the time the mainstream media covers a financial unwind, it's already too late. The smart money moves early. The leveraged money gets forced out, and retail investors are left holding depreciating assets. This is how wealth gets transferred, not through crashes that everyone sees coming, but through structural shifts in liquidity that most people don't understand until they're already underwater. If the Bank of Japan continues tightening, even gradually, the math becomes unsustainable for carry traders. If the yen continues strengthening, losses accelerate. If enough capital tries to exit at once, market analysts warn you could see a liquidity crisis, not just in currency markets, in equities, in credit, in derivatives tied to those positions. The mechanics are simple, but devastating. When carry traders unwind, they must sell U.S. assets. Tech stocks that rallied for years on cheap yen liquidity suddenly face selling pressure. High-yield bonds that attracted leveraged flows, see spreads, blow out. Emerging market currencies that benefited from the hunt for yield get hammered. The Mexican peso, Brazilian real, South African rand. In August 2024, these currencies depreciated sharply when the yen spiked, exactly as many currency strategists had predicted. But the unwind in August was partial. Many analysts estimate that only a fraction of the total carry trade positions were closed. Market participants suggest that trillions in positions remain. Some hedge funds reduced exposure. Some retail traders in Japan, known colloquially as Mrs. Watanabe, were forced out by margin calls. But the bulk of institutional money, pension funds, insurance companies, and long-term investors are still positioned in the trade. They're waiting, watching, hoping the yen stabilizes, hoping the Bank of Japan pauses its tightening cycle, hoping they won't be forced to liquidate at unfavorable prices. But hope, as market veterans know, is not a strategy. Some strategists suggest this could be the catalyst for the next major market correction. Not a Fed policy mistake, not a geopolitical shock, but the quiet unwinding of one of the largest, most leveraged trades in modern financial history. And here's the part that should concern every investor. Most of the risk is invisible. It's buried in the balance sheets of banks, hedge funds, and institutional portfolios. It doesn't show up in headline numbers. It's not discussed in earnings calls. It's implemented through derivatives, foreign exchange swaps, cross-border lending arrangements that don't appear in standard financial reporting. But it's there, levered, interconnected, fragile. History shows us that these hidden risks are the ones that matter most, because when they break fast. The 2008 financial crisis wasn't caused by the risks everyone could see. It was caused by the interconnected leverage in the shadow banking system that almost no one understood until it was too late. According to financial historians, the same pattern emerges repeatedly. Invisible leverage, hidden in complex instruments, suddenly becomes visible when markets turn. Right now, global investors are watching the yen. They're watching Japanese bond yields. They're watching currency volatility indicators. They're calculating exposure, stress testing scenarios, and preparing for potential dislocations. If you're not paying attention, you're already behind. There's a broader implication here that goes beyond just the carry trade. Japan has been exporting deflation to the world for decades. Ultra-low Japanese rates pushed capital everywhere else. That capital inflated asset prices globally. It kept borrowing costs low. It enabled governments to run massive deficits. It fueled the tech boom. It drove real estate higher. It made risk-taking profitable. If that flow reverses, many economists argue the entire global financial architecture has to adjust. Asset prices that were inflated by cheap yen liquidity could deflate. Countries that relied on Japanese capital to fund deficits may face higher borrowing costs. Central banks that assumed abundant global liquidity might find conditions tighter than expected. The implications cascade through every market. U.S. Treasuries could see sustained selling if Japanese investors repatriate funds or hedge their currency exposure. Corporate credit spreads could widen if leveraged carry trade positions unwind. Equity valuations could compress if the flow of cheap capital reverses. Real estate markets could cool if foreign buyers pull back. And then there's the timing question. Markets, as analysts frequently note, can remain irrational longer than investors can remain solvent. The carry trade could limp along for months, even years, if the yen weakens again, or if the Bank of Japan pauses its tightening. Some market participants argue that the worst is over, that the August unwind relieved the pressure, that carry trades can continue profitably at current rate differentials. But the structural forces suggest otherwise. Japan's inflation remains above the 2% target. Wage growth is accelerating. The Bank of Japan has explicitly stated its intention to normalize policy. Political pressure in Japan is building to strengthen the yen, and global investors are increasingly aware of the tail risks. The conditions that sustained the carry trade for decades are eroding. The risk-reward profile has fundamentally changed, and even if some traders continue the strategy, the marginal flows that drove markets higher may not return. For American investors, this matters more than most realize. The S&P 500 hit record highs in 2024 with a price-to-earnings ratio exceeding 29. Well above the long-term average of around 16, technology stocks led the rally, reaching valuations that some analysts consider historically stretched. Much of that appreciation occurred during a period of massive global liquidity, fueled in part by yen-funded flows into U.S. assets. If that liquidity reverses, the downside could be significant. History shows that markets built on leverage and borrowed liquidity correct violently when the funding disappears. The dot-com crash, the financial crisis, the COVID sell-off. Each involved a sudden withdrawal of liquidity that exposed overvaluation. The Japanese carry trade isn't some obscure corner of finance that only matters to currency traders and quantitative hedge funds. It's been a structural pillar of global liquidity for decades. And if current trends continue, according to many financial strategists, its breakdown could be one of the most significant financial events of the next several years. This is the risk almost no one is talking about. The risk that doesn't make headlines until it's already causing chaos. The risk that sophisticated institutions are quietly preparing for, while retail investors remain completely unaware. When retail investors finally hear about the carry trade unwind, it will likely be in the context of explaining why their portfolios are down 20, 30, maybe 40%. They'll read articles about how Japanese rate hikes triggered a global deleveraging event. They'll wonder why their financial advisor didn't warn them. They'll question why this massive systemic risk wasn't more widely discussed. But by then, the damage will be done. The pattern is always the same. Hidden leverage builds up during periods of stability. Everyone assumes the conditions that made the leverage profitable will continue indefinitely. Risk models fail to account for what happens when those conditions change. And then, suddenly, the structure breaks. Not gradually, all at once. If the Bank of Japan continues its normalization path, if the yen continues to strengthen, if global risk appetite weakens for any reason, the carry trade unwind could accelerate rapidly. Margin calls could force liquidations across multiple asset classes simultaneously. Liquidity could evaporate in moments of stress. Correlations could go to 1 as everything gets sold to raise cash. These aren't predictions. These are the documented mechanics of how leverage trades unwind when the underlying conditions shift. We saw it in August 2024 on a small scale. We could see it again, potentially much larger, if the trends continue. The Japanese carry trade breakdown isn't a question of if. Many analysts argue it's a question of when and how severe. The forces driving the unwind are structural, not temporary. Japan's monetary policy is normalizing after decades of extreme accommodation. That normalization, if it continues, fundamentally changes the calculus for every institution running carry trade strategies. Right now, you have a choice. You can ignore this because it seems technical, distant, unlikely to affect you personally. You can assume that someone, somewhere, has this under control. You can believe that markets will remain calm, that liquidity will stay abundant, that the conditions of the past few years will persist. Or you can recognize what the data is showing, what the institutions are preparing for. What history tells us happens when massive leveraged trades built on cheap funding suddenly face higher costs and currency moves. The smart money isn't making predictions. They're managing risk. They're reducing leverage. They're stress testing portfolios. They're preparing for scenarios that most retail investors haven't even considered. Because they understand something critical in markets. It's not what you know that kills you. It's what you think you know that isn't true. For decades, investors thought the yen would stay weak, Japanese rates would stay low, and dollar assets would keep rising. That assumption funded trillions in positions. Now that assumption is being tested, and if it breaks, the consequences could reshape global markets for years to come. This is the risk almost no one is talking about, but everyone will feel.